Welcome to your grade 10 accounting lesson. Today we are going to deal with the analysis and interpretation of financial statements. A big word, hey? Let's start with the simple one. What is a financial statement? A financial statement is a report that gives you the performance of the business over a period of 12 months at least, which is called a financial year. This financial statement is very much like your school report card. Your school report card tells your parents about your performance in school for that academic year. And your academic year is 12 months, normally starts from January to February. So you see, financial statements also are for a period of 12 months. But unlike your school report card, the financial year is not a period from January to December. It is from the month in which the company started trading or when it was established. If, for instance, the company was established on the 1st of March 2016, then its financial year will end on the 28th of February 2017, which is your 12 months. This is very much like your birthday. We all go through January to December, but each and every one of us has their birthday in the month in which they were born. So you see, accounting is very easy. Financial year, a period of 12 months, starting from the month in which the business was established. Now, today we are going to analyze the financial statement. What is analysis? Analysis is a process or a procedure whereby the financial statements are examined line by line in order to determine the relationship between the various items or line items in the financial statements. When we talk of line items in a financial statement, look at the statement of income. You have your sales as the first line item. You have cost of sales as the second line item. You have gross profit as the third line item. That is what we mean by line item. And you can also use the same for your school report. In your school report, you will have each and every subject that you are taking in school reported on. Each subject can be taken to be a line item. Now, why do we do a line-by-line item analysis? Remember, we said we are examining each and every line item to determine its relationship with the other line items in the financial statement. This we do by means of performing calculations. That is how we examine things in accounting. Unlike a doctor that will take your pulse, check your blood pressure. No, in accounting, we perform an analysis, we perform an examination by doing calculations. And the result of the calculations that we do is known as a ratio. Let me give you another example that will help you to understand this much better. You write a test in accounting and the total marks in the test is 10 and you obtain 6 out of 10. Now we are going to do an analysis. We say 6 divided by 10 multiplied by 100 is 60%. So your performance, your ratio is 60%. This is a ratio because it gives us a relationship between yourself, your performance, and the test. A ratio, my little boys and girls, refers to the relationship between the various line items. And once you have done this, now you must go to interpretation. What is interpretation? Let me give you an example. You have just written a test out of 10 and you obtained 2 out of 10. Will that make you happy? No, of course not. And why will you not be happy? because 2 out of 10 is 20% and it is a fail. And you know that in order to pass accounting, you must get at least 30% and above. So you see, we are already interpreting. Interpretation is a process whereby we give meaning to the ratios that we have calculated. And the importance of interpretation is that it gives us feedback on the performance of the company. It shows us the areas where we are not performing well, and we identify strategies or ways in which we can improve performance so that the company can become prosperous or profitable. Now, interpretation, analysis and interpretation of financial statements focuses on various ratios. We do profitability ratios, we do liquidity ratios, we do solvency, and we also do return on equity. In this lesson, we are going to focus on profitability ratios. Before we do profitability, let us ask ourselves, what is profitability? Yes, you guessed well. Profitability is from the word profit. And we know that profit is sales minus cost of sales, and that is the amount that is due to the business after we have sold goods or services. And profitability, it shows as to whether the business has achieved its objectives or not. And it also shows how efficient the business was in doing its sales. Let me take you back again. If you are going to write a test out of 10 marks and you write the test, you finish the test after 2 hours, would you say that you did well? No, of course. Because you should be able to finish a test of 10 marks in less than 5 minutes. Now, if you took more than 5 minutes to finish that test, it means you are not efficient. In the same way, when we do profitability, we determine as to whether the business has been efficient. Did it not waste resources in making its profit in its operating activities? Now you may ask this question, what are operating activities? Operating activities refers to the main activities of the business, and normally it is buying and selling of goods. Now, just to refresh your minds, I would like to know, in which financial statement will you get profit? Yes? The income statement. Well done. And what are the line items in the income statement that reduce the amount that you have received from your sales? Come on. What is the line item that follows after the sales? It is cost of sales. And what is cost of sales? Cost of sales is the money that the business has spent on the trading inventory or the stock that it has sold. And sales minus cost of sales, we said, is gross profit. After gross profit, we have other income. We can get this income maybe from rent, and this increases our operating income. Now there is another line item that is going to reduce the gross profit even further than the cost of sales. What is that line item? It is your operating expenses. For example, your telephone expense, your depreciation, the money that you spend on fuel, the money that you spend on maintenance of vehicles, and so forth. And even bad debts. Those are your operating expenses, and they eat up the gross profit. So you see, if you have too many operating expenses, it means at the end of the day, your profit is reduced. Now, as accountants, boys and girls, we are very, very important people. We are here to solve the problems of business. Now, let us give business advice. How can they improve their operating expenses? How can they control them in order to make sure that these operating expenses do not eat up their gross profit? They can do this, for example, where the telephone is concerned. They restrict the number of people that can have access to the telephone. Maybe only the senior staff in the business can have access to the telephone. And even the senior staff, they must use pins when they use the telephone so that we do not waste resources. And by doing so, we can improve our profitability as a business. One other item that eats into the gross profit, we said it is the cost of sales, which is the buying of stock. Now, what can make our stock to be expensive? It could be that we are buying from suppliers that are very expensive. And therefore, to solve this problem, we must do research as a business. We must look around and find suppliers who are cheaper. But remember, we must not buy cheap material that is of poor quality, because if we do so, we are going to lose our customers. And if you sell material or products that are of poor quality to your customers, it is unethical. Remember, we spoke about ethics. Ethics refers to good standards in performing your business. So, even as you are buying cheaper stock, it must be of good quality. You see now, business is listening to us, and they are going to do the things that we are telling them today. And one other item that will reduce our profitability will be trading stock deficit. Trading stock deficit means that our stock count has shown that the number of items that we have on hand are less than the number of items that we should be having, which shows that stock is being stolen. So how can we prevent the theft of stock? We can hire security. And we can also install cameras. This will definitely improve our profitability. Now, when we do profitability, we use various ratios. And these are our ratios. We use gross profit on cost on sales, which is gross profit divided by sales multiplied by 100. We do gross profit on cost of sales, which is your gross profit divided by your cost of sales. We do operating expenses on sales, which is operating expenses divided by sales multiplied by 100 divided by 1. We do operating profit on sales, which is operating profit divided by sales multiplied by 100 divided by 1. And we do net profit on sales, which is your net profit divided by your sales multiplied by 100 divided by 1. If you are observant, you shall have realized that almost all these ratios are divided by the same line item. Which line item is that? It is sales. So sales is a common denominator in almost all these ratios. Now I'm going to teach you a secret. In order for you to be able to remember these ratios, let us develop an acronym. Instead of saying gross profit on sales divided by sales, operating expenses on sales divided by sales, operating profit on sales, net profit on sales, let us just say GROPEX open divided by same. Now, what does the GROPEX Open stand for? The GR will stand for your gross profit. The OPEX will stand for your operating expenses. The OPE will stand for operating profit. And the final N will stand for net profit. And all this divided by sales. Now, you know 1, 2, 3, 4, 5 ratios already. You've got them all correct. And let me give you a tip. In the examination, you are almost likely always to get sales figure given in your financial statements. So, the amount of sales that you write on your statement of income, all you have to do is to take it down into your ratio. If you transfer that figure for sales into your ratios, you are going to earn a mark for just doing that. And it means already now, if the profitability ratios carry 15 marks in the examination, you already have 5 marks for free. So boys and girls, always make sure that the sales figure in your income statement, you transfer it. Irrespective of whether it is wrong or right, you transfer it to your ratio. Then you earn marks on that. Let us do an activity, an exercise, to determine as to whether we understood the lesson up to this point. You are required to do the following. Calculate the profitability and comment whether it is too high or too low, and how does it compare with the business markup policy. Round your final answer off to 1 decimal place. You are given the financial statement of a sole trader. Question number 2. Can the business reduce its expenses further? Number 3. How does the business compare with its competitors? Let us look at the information. The information that we have here is an extract of the income statement for the year ended 28 February 2017. Now tell me, when did the financial year of this company start? The 1st of March 2016. And it completes 12 months on the 28th of February 2017. And that is its birthday, that is its financial year. These are the figures, your sales, your cost of sales, gross profit. Go through this income statement and calculate the ratios that are given. And you are also given the percentages of the previous year, which was 30 June 2016, and they are given in brackets next to the ratios. Let us do the first ratio. The gross profit on cost of sales is 55.6%. Should the owner be happy with this ratio? No. The owner should not be happy with the ratio because the business aims to achieve a markup percentage of 100%. So 55.6% is lower than 100%. Therefore, we realize that cost of sales is eating up our revenue. It is eating up the money that we got from sales. Now, how can we improve on cost of sales? Remember, I told you tips on how we can improve on this. We have to buy from cheaper suppliers, but we must make sure that we buy material that is of good quality. The second ratio that we are going to do is gross profit on sales. Our gross profit is 150,000 Rand on 420,000 Rand. Multiplied by 100 divided by 1, and this gives us 35.7%. Should the owner be happy with the gross profit for this year? No, the owner should not be happy. The gross profit on sales for the previous year was 50%, and for 2017 it is 35.7%. Therefore, it has declined, and we cannot be happy. Operating expenses on sales. What is the amount for our operating expenses? 65,100, and our sales is 420,000. Multiplied 65,100 divided by 420,000 multiplied by 100 divided by 1 is 15.5%. So for the financial year of 2017, the ratio is 15.5%, and for 2016 it was 40%. Should the owner be happy with this? Of course, it means that we have improved, our operating expenses have gone down, and therefore the business is controlling its operating expenses well. Our last ratio is net profit on sales. Our net profit for 2017 financial year is 78,000, and our sales is 420,000. 78,000 divided by 420,000 multiplied by 100 divided by 1 is equals to 18.6%. The ratio for 2016 was 17%, and in 2017 it's 18.6. Should the owner be happy with this ratio? Yes, because 18.6 is higher than 17%. Therefore, our net profit ratio has gone up by 1.6% for the 2017 financial year. Now, what could have led to this improvement? Remember, our operating expenses have also gone down. So if operating expenses are less, it means net profit is being increased. Now you are ready for your homework. We are going to do homework, and you are going to apply the principles that we have learned here. I just need you to remember that when you do your interpretation, you must follow the following steps. You must give us the ratio for the current year. You compare it with the ratio for the previous year, and you comment. You tell us as to whether the ratio has improved or as to whether it has declined. And you also give us what could be the possible causes of the improvement or the decline. And remember, you must give the business advice on what they can do in order to improve the particular ratio that you are discussing. Thank you.